The recent escalation in the Middle East has shown that geopolitical events matter for capital markets. We've seen an increase in oil prices and gold in this environment of heightened uncertainty, and on the other hand, equity prices were down. Now we have avoided a conflagration in the region, and this has helped to correct these earlier moves. Nevertheless, the threats on this side are still looming, and we still have a heightened risk of terror attacks around the world. Also, the war in Ukraine is far from being over, but we have seen some progress in this direction by passing a law in providing support for the Ukraine in the US Senate. But we should not count for peace in both of the war regions anytime soon. So this will remain an issue for financial markets going forward. What we have learned in the recent experience with the increase in some commodity prices is that it's not oil and gold that's going up, but it's on a broad level. We have seen an increase in commodity prices for industrial goods and also for agricultural goods. And this is partly to do with the fact that in the period of increasing interest rates, investment in exploration of those goods went down. And on the other hand, we see some increasing demand, despite the fact that the US economy is likely to slow down and that the Chinese economy is not going with a high pace we used to see there. So in the result, commodity prices have made a turnaround, and this is likely to feed through to consumer prices in the course of the year. And this comes on top of the elevated pressure from the service sector on both sides of the Atlantic. As a consequence, we have increased our forecast for US inflation from 2.8 to 3.1% this year, and we keep our above consensus forecast for the euro area of 2.7%. That means for central banks that the way down in inflation is everything but clear, and therefore they will probably be hesitant in lowering interest rates. Nevertheless, we will see a historic novum this year by the ECB cutting before the Fed. So far, we have only seen in 2011 a period where the ECB tried to increase interest rates, but that didn't work out because the debt crisis was coming around the corner. Now, for this year, we expect the June to go ahead with the first rate cut in June, and then the Fed following in July. After that, the ECB is likely to continue with the next step in September, and the Fed is likely to wait until December. Now, for the Fed, we have the special situation that the elections are coming up in November, and we think that they want to keep some time between the first rate cut and the election. Therefore, it's a bit of a longer pause on the US side. In this environment, markets will remain volatile. But with the rate cuts materializing, we think that the recent hikes in the long end has been the end of the story, and we expect the tendency of the long end yields to come down, and we will see somewhat lower long-term yields in a year's time.